Alphabet posted Q2 2026 revenue of $119.8 billion, up 24% year over year, the 12th consecutive quarter of revenue growth, alongside GAAP earnings per share of $9.11, up 294% from Q2 2025. Per Alphabet's 8K filed with the SEC this morning, the results were accompanied by a full investor earnings call. Despite those numbers, the stock dropped roughly 5% after hours. The reason, stated explicitly by management on the call, was a hike in full-year 2026 capital expenditure guidance to $205 billion, with 2027 spending projected to go even higher. A company can beat earnings and still fall. This is why. The core advertising business, Google Services, reported $94.5 billion in revenue, up 15% year over year, with operating income of $39.5 billion at roughly a 42% margin. YouTube advertising contributed $11.1 billion, up 13%. Subscriptions, platforms, and devices added another $12.9 billion. These are not the numbers of a business losing ground. Every line within Google Services posted positive growth, which means the after-hours sell-off has nothing to do with the ad business performing badly. Google Cloud was the standout performer, $24.8 billion in revenue, up 82% year over year, with operating income of $8.8 billion at approximately a 35% margin. Growth was driven by AI-specific infrastructure and GCP solutions, the enterprise layer of the broader AI build-out. Cloud has moved from a segment that used to drag on consolidated margins to a multi-billion-dollar profit center. The 82% growth rate is the kind of number that would normally move a stock higher on its own. Search and other revenue reached $63.3 billion, up 17% year over year. The growth matters because the dominant concern around Alphabet for the past 2 years has been AI-native search alternatives eroding the core business. The revenue data so far does not support that thesis. Management noted on the call that AI-enhanced search results are driving higher query volumes, not cannibalizing them. Whether that holds as competitors improve is a separate question, but for Q2 2026, the search business looks resilient. Here is the tension. Alphabet's operating cash flow in Q2 was $39.1 billion, strong by any measure, but free cash flow came in at negative $5.9 billion. That gap implies quarterly capital expenditures of roughly $45 billion. Annualized, that pace aligns directly with the company's revised full-year 2026 capex guidance of $205 billion. Management was explicit on the call. 2027 spending will be higher still. Against a backdrop where the 10-year Treasury yield sits at 4.6%, per the most recent Federal Reserve data, investors are applying a real hurdle rate to those future returns. Infrastructure spending with multi-year payback periods looks different at 4.6% than it did when rates were near zero. Alphabet is not alone in this position. Microsoft, Amazon, and Meta have all raised AI infrastructure budgets substantially through 2025 and into 2026. What distinguishes Alphabet is the funding source, a high-margin advertising segment that generates enough operating cash every quarter to absorb elevated capex. In theory, the question investors are now pricing is whether that buffer narrows before AI infrastructure starts generating returns at scale. The GAAP operating margin for Q2 came in at 34%, solid on its own. But operating margin and free cash flow diverge sharply when capex is this elevated. When capital expenditures consistently exceed free cash flow generation, the company is funding future infrastructure on the assumption that revenue will grow fast enough to close the gap. Alphabet has done this before, during the early YouTube build-out and the early Google Cloud investment phase. Cloud's $8.8 billion Q2 operating income is the clearest evidence that the model can work. The current debate is about timing. 3 things investors will be watching over the coming quarters. First, whether Google Cloud's growth rate holds as the revenue base gets larger. High growth rates compress naturally as the denominator scales. Second, whether AI-enhanced search continues to expand advertising revenue, or whether competitor alternatives start appearing in the numbers. Third, and most important for the stock near term, whether management provides any ceiling on capex intensity heading into 2027. Without a clear spending plateau, the gap between strong reported earnings and compressed free cash flow stays open. And that gap is what drove the after-hours move.